Good morning, everyone. Welcome to the December version of Money Corp's monthly webinar. So the last one of the year. Hope you're all filled with Christmas cheer. I'm Neil Parker, Head of Economics and Market Strategy here at Money Corp. I'm delighted to be your host today. So it's the holiday season. It's in full flow. We've seen an awful lot already in terms of market moving events, in particular the FOMC. And in this webinar, I'm going to be covering more with regard to the global outlook, what we're expecting to see at 12 o'clock today from the Bank of England, and the implications of the recent budget by the UK government. We'll also look at the outlook for 2026 for a number of economies. During the session, you won't be able to use your audio or video. If you want to submit a question, then please do post them in the chat box. Do so throughout the time that I'm talking, and I'll try and get through as many of them as I possibly can at the end of my presentation. But thanks very much for dialing in to these webinars. We really do appreciate it, and I look forward to answering as many of those questions. And if you don't feel comfortable to ask a question online, then feel free to reach out directly to me afterwards, and I'll get back to you. So without further ado, we're going to go into the presentation itself, and we'll look at, first and foremost, growth. The outlook for growth is still quite disappointing, and that's in spite of the fact that we've seen quite significant monetary policy loosening from the major central banks over the course of this year. Obviously, the European Central Bank got out of the gate quite early on monetary loosening and have now paused. Whereas what we're seeing from the likes of the Bank of England and the Federal Reserve is a game of catch-up. That said, none of the loosening that we've seen thus far appears to be having much of a positive impact on economic activity. And I think that's probably best highlighted by the euro area, where growth is expected to again disappoint in 2026. And that's despite the fact that their interest rates are now less than half of what they were at their peak. So there's still more work to be done in supporting economic growth. Now, that might come more fiscally than it does monetarily, but I think the same can be said of the likes of the US and the UK in 2026, where growth is liable to disappoint again. And it might be that we have to wait until 2027 before we see any material improvement in economic activity. The other thing to note is that unemployment is rising in a number of areas, and we saw that in labour market data out of the UK and the US this week. So that is another net drag on economic activity going forward. One other thing to note on these growth numbers from the IMF and the Organisation of Economic Cooperation and Development is that we're expecting to see additional weakness in the likes of China and also India. And those two have been the bastion of economic activity. They've really been the engines of growth globally for the last decade or so, supported well by the US until recently. But even there are headwinds that are approaching both of those economies. And I think as a consequence, we may well see further monetary loosening from both of those economies in order to try and support domestic activity, prompting it to rebound. But again, 2026, probably too early to anticipate that. And notable equally is the strength or relative strength of performance in the Swedish economy. Something that I noted in a recent presentation to a client directly was the fact that Sweden, who have cut interest rates very aggressively and also begun stimulating their economy with a raft of fiscal policies that are going to add something like 2 percentage points onto economic activity, it does show that it can pay off if targeted and directed at the right area. So Sweden might be the economy that outperforms the rest of Europe over the course of 2026. Looking at the UK's fiscal policy, there was a whole raft of measures, and I think I described this particular budget as a payday loan type budget, which is spend now and then pay it off later on, because all of the spending measures that have been introduced in this most recent budget appear to be targeted towards now, and all of the taxation measures appear to be targeted more towards the end of this parliament. So it might be laying a trap for any future government, but it also might be the case that economic conditions are insufficiently robust to withstand further increases in taxation at this moment in time. I think that the major areas of taxation that the Treasury decided to placate were an additional freeze in personal tax thresholds through to the end of tax year 3031, so an additional 2 years of those income tax thresholds being frozen. Also, they've made changes to things like salary sacrifice for pensions. Both of those measures are expected to bring in several billion in additional tax revenues. Obviously, the personal tax thresholds likely to bring more in than we would expect to see from the changes to the salary sacrifice. But there was also changes in terms of taxation for electric vehicles. One of the things that's been a success for this government and the previous government in terms of the switch over from hydrocarbon-based vehicles over to electric and hybrid vehicles is causing them a bit of a problem in terms of tax revenues. So they're going to levy an additional tax-raising measure, again targeted towards the end of this parliament, in order to address the gap that's being created, the widening gap that's being created as far as fuel duties, bringing in less cash, and obviously electric vehicles not bringing in any in that traditional measure. And there was one measure that I think UK retailers could probably get behind, which was the reform of customs treatment on low value imports. So for the likes of some of the retailers that are using the UK as a conduit towards faster growth in their home and domicile countries, they are now going to not be able to send small value packages that attract no duty. They will attract the same levels of duty from March 2029 that are faced with higher value imports. So that may well level the playing field, or at least help to level the playing field from a retail perspective. But I think once we look at the assessment of this budget, and whilst the markets seem to be quite positive on it, I am less so. Many people say that I'm always depressed about budgets and things like that, but on this one, I think the additional spending, which was some 155 billion pounds on top of what was already committed, it's an enormous number. And although taxation is expected to rise by, roughly speaking, around 95 billion over that same time horizon, that still leaves them with an additional gap of around 60 billion pounds in additional deficits. So this isn't a budget that actually helps to correct a lot of the problems that we're seeing with regard to the UK public finances. In fact, if anything, it exacerbates them. And I'm still a bit surprised that we haven't seen a more material reaction in financial markets to that huge increase in spending over the course of the remainder or the lifetime of this parliament and over the forecast horizon. So my assessment of the budget is that, having said that they weren't going to come back for more tax increases, the government had to. They had to because they were pre-committed to a number of spending increases that would have left an even bigger gulf in the public finances. But I am worried that additional spending, additional tax increases that are already factored into a growth downgrade that we've seen from the Office for Budget Responsibility are going to put additional downward pressures on the UK economy. And one of the other things to note is that the Office for Budget Responsibility won't be publishing 2 forecasts a year now. They'll only be required to publish 1, although they may well be producing 2, but they'll only publish 1. And that means that in terms of big fiscal policy decisions, we should not expect the March spring statement to come up with significant policy changes unless absolutely required, something that the Chancellor, Rachel Reeves, was at pains to point out. What about interest rates across the globe? Well, I've mentioned about the fact that we've had some rate cuts already, a 25 basis point cut from the Federal Reserve. That cut was probably the most fractious in terms of the debate that we have seen amongst the Federal Reserve, really over my lifetime in analysing economies and financial markets. So 3 members voted against the cut, 9 members voted in favour of the cut. 2 of those that voted against the cut said that rates should be left on hold. 1 said that they should be cutting rates by 50 basis points. But there were 4 other members of that committee that said that they were uncomfortable or expressed concern about the decision, but voted for it in any case. So it does show this fracturing of opinion amongst the Federal Reserve's Open Markets Committee. And I would mention that this does demonstrate that whoever takes over from Jerome Powell, once we know who the president's nominee is going to find it difficult to cut interest rates in that sort of environment. I don't think they're going to get their own way particularly easily. So it might not be the case that changing the head of the Federal Reserve will change the direction of travel as far as US interest rates are concerned. As for the Bank of England's meeting at 12 today, well, we're expecting, and the markets are expecting, a 25 basis point interest rate cut, but it's far from straightforward. And the inflation numbers that we saw yesterday did not give the green light, as many people thought that they did, to that interest rate cut. I think there are several things that the Bank of England will remain concerned about. Top of that list is services inflation, that's running at more than double the rate of targeted inflation. Moreover, the bigger than expected drops that we saw in headline inflation and also CPIH, which is the preferred measure of the Bank of England, a lot of that was down to the budget timing and the fact that tobacco duty rises didn't occur in time for the cutoff period, prior to the cutoff period in this November, but they did last November. So December's inflation figures may well see some upside risks. European Central Bank, on the other hand, well, it's probably a lot easier for them. They don't have to do anything, and they probably won't do anything as far as cutting interest rates are concerned. There's another potential surprise on the horizon, which is not only the Bank of Japan raising interest rates on Friday, but the prospect of additional rate increases to come. So their interest rates are rapidly rising to multi-decade highs. That's not really that hard when you consider that they've been at 0 for such a long period of time. But the Bank of Japan do have a short to medium term inflation problem that they have to get on top of. And that job is not being made any easier by the fact that the Ministry of Finance and the government are trying to inject additional fiscal stimulus into their economy. So Bank of England's outlook, well, I think there will be further interest rates interest rate cuts to come. Federal Reserve, further interest rate cuts to come, but both of them are probably priced for by the financial markets, or pretty well at least. The European Central Bank, the markets perceive there being virtually no chance of a further interest rate cut, which I continue to scratch my head at because they have very weak domestic growth. And I think the risks are to the downside as far as inflation is concerned. And I mentioned Sweden previously, I'll mention them again. I don't think that the Riksbank necessarily need to reduce interest rates any further, given that big stimulus that's coming already in train from the Swedish government. Now, for the US, big question is what's happening in the sort of real economy. And there's 2 main problems here, which is that the housing market is still very subdued, so it hasn't recovered back to levels that we were seeing pre-COVID. And equally, there are some other additional problems or wrinkles in the labour market. So although they're still printing jobs, it's at a much slower pace, and unemployment is rising. So there are more people seeking jobs than appear to be able to accept jobs. And businesses are reluctant to hire, or at least more cautious about hiring, not only in the US, but we've seen that in other economies as well. That might be because of increasing costs elsewhere. So overall, I'm not sure that just lowering interest rates is enough to save the US economy. We've seen from President Trump that he might be looking to write some big checks to every household across the US of either $1,000 or $2,000, but that will punch an even larger hole in their public finances. And so that is problematic for them at the moment. I'm not sure that, as I say, on its own, lower interest rates will save the economy. And I do think that they need to reconsider the situation with regard to tariffs. I think tariffs are one of the reasons why we've got slower growth and higher inflation in the US. If you are old enough like me to remember when Labour came to power in 1997, Tony Blair was welcomed to the tune of "Things Can Only Get Better" by Dee Ream. I'm not advertising that as a choice for Christmas listening. However, I think the question is, will things get better for the euro area? Because despite these big cuts that we've seen in interest rates, taking us down to levels previously seen back in 2022, I'm not sure that that's enough on its own either to stimulate faster rates of economic growth. The euro area and the UK and a lot of other economies have a productivity problem, and that isn't able to be resolved in the short term. Moreover, fiscally, all of the economies are challenged, with probably the exception of the German economy, and they are stimulating, but a lot of their stimulus payments are going into areas like the defense sector. So the big drivers of economic growth that we've seen in the euro area, and particularly in Germany over the previous sort of 20, 25 years, around auto sales, I don't think that's going to be necessarily supported that much by the improvement in borrowing costs that we've seen for consumers and also for businesses. One final thing with regard to the car makers is that we've seen a modest loosening in the net zero targets from the euro area. So the European Union announced that instead of there being 100% cars that would need to be made in the EV market, fully electric market, by 2035, they're now saying it can be 90%. I'm not sure that will provide that much comfort to automakers across the whole of the euro area, but it does show a direction of travel. Now, if we look at FX forecasts, well, they haven't changed that much, even though we have seen some upside for sterling against the US dollar. And I still think that the pound is under pressure. The upside risk is around about 134. I know we've been above 134 in sterling dollar and around about 114.50. And I know we've been above there in sterling euro. After the budget, the downside risk is still there as far as I'm concerned. And I know I'm probably in a community of one on that viewpoint, but I see sterling downside risks as far more prevalent than any upside risk, particularly from a domestic economic perspective. Looking at the US dollar, the downside that we've seen is a bit of a head scratcher as far as I'm concerned. I mean, I think it is linked to the possibility that the Federal Reserve will cut interest rates way more aggressively than it's priced for at this moment in time. But I'm just not convinced that they'll be able to get away with it. For the euro, it's still holding up much better against the US dollar, and also it's holding up well against the pound. And I wouldn't be surprised if we see additional strength, as in it'll hold up better against the US dollar than other currencies. And I'm particularly looking at the likes of the pound and also the Canadian dollar. Both the pound and the Canadian dollar have had a decent run of form recently on the back in Canada's perspective of some better economic news, improvements in the labour market again, albeit it's coming from part-time work, and some improvements as far as economic activity is concerned. But they've still got inflation very well anchored to the 2% target level, and consequently, I don't see any movement in interest rates going forward. There are a whole host of other currencies up there. If there are currencies that aren't on this particular slide that you'd like some forecasts on, then please reach out to your Moneycorp contact. And if you don't have one of those, reach out to me and I'll make sure that we can get something to you. In terms of the rest of the presentation, well, there isn't a rest of the presentation. That's it. It leaves me on this slide just to remind you that if you are looking at budgets or FX plans, then do reach out to us on the numbers that are on screen now. Now we can go over to the Q&A, which we've had some already submitted, which is nice. It shows that I am actually speaking to real live people. So the first one is, will the changes to energy prices announced in the budget materially impact inflation? Now, I'm probably going to get myself into a little bit of trouble because I think that the energy price change that we saw announced by this government was a blatant effort to try and bring the level of CPI inflation down. And it appears that it is going to work because if it's all passed through, and a number of the energy companies haven't said whether or not they will do at the moment, but if it is all passed through, then it will have a negative effect on the headline inflation rate of around about 0.3 to 0.4%. It will also do the same sort of thing to CPIH. That said, I am not convinced that all of the energy companies are going to pass it through. So it might have a somewhat lesser impact, but it will still be a negative influence on inflation, bringing it closer to target than it otherwise would have been. So there were some suggestions. What they might do is they might look to end VAT being levied on energy costs. They haven't done that. They've done something different. It will have a short-term or one-off impact on the inflation rate. And so it does look as if it's going to be material and could encourage the central bank to reduce interest rates further, albeit the central bank's target is over sort of 2 to 3 year time horizon, whereas the effect of this is probably going to be much shorter, within a sort of a year or so. Another question that we've got here is, if the Bank of England were to cut interest rates below 3%, what would that mean for sterling? Well, I think it would mean a significant additional downside risk to the forecast that you've already seen, potentially pushing sterling dollar through 120 towards sort of 115, and sterling euro below 110, possibly towards its ultimate lows at 105. That said, I don't see that much prospect of UK interest rates falling below 3% uniquely. So I think that if interest rates were going down to and below 3%, it would be because there were some sort of material global economic risks that have emerged over the course of 26 or into 27. So unless this was something unique to the UK, then it might have a much less material impact on the pound's value against other major currencies. So thank you for that question, by the way. Do the markets really believe that the European Central Bank's next move will be a hike? Yeah, they do, and I don't understand why. Honestly, I think the European Central Bank are doing a great job at trying to dampen down everybody's expectations about interest rate cuts, but they're not really in control of that decision. Ultimately, it will be judged by what happens to inflation and what happens to growth. And short-term effects on both of those appear to be more downside than upside. So despite them talking up the prospects of higher growth next year, I mean, that's all relative. It's still going to be pretty subdued. And despite them talking up the inflation risks, or at least saying that they're better balanced, I don't think that the risks at the moment would suggest that rates are going anywhere. But I think if there are risks, second half of 2026, rates lower, not rates higher. So again, I am in a group of one on that particular view at the moment versus what the rest of the markets think. We don't have any further questions at this moment in time. And as it's Christmas, I'm going to let you all go early. So thank you very much for your attention today. I hope you found the session useful. I hope that you will continue to subscribe to this and also to our daily market pulse. And please give us feedback if there's things that you want to hear about that aren't in the either this webinar or in that daily market pulse, and we'll try and accommodate. Or if we can't accommodate it into those documents, I can always write something unique to your business. We'll share a copy of the recording shortly. If you'd like the slides, please reach out to your usual contacts at Money Corp, or give the team a call using the numbers on the screen. And you're going to receive another short feedback survey from us. We do appreciate you filling it in, telling us what you think. You know, even if, as somebody did, telling us about what the weather was like in Italy. I appreciate that, because at least it means that when it comes to holidays, things might be looking up. But have a great holiday season. If you celebrate Christmas, enjoy your Christmas. If you don't, just enjoy the break. We look forward to speaking to you again in January, and we'll share details of when the webinar will be in due course. Thanks very much for listening, and goodbye.